As of 11:36 a.m. Eastern Time, BigBear.ai Holdings, ticker BABA, is absolutely erupting. The stock is currently trading at $7.03, which is a staggering 16% gain on the day, up 97 cents. The volume is astronomical, with over 101 million shares having already changed hands, completely dwarfing its average. This is not a mild drift, this is a violent, decisive move, and it's all happening on the heels of the company's third-quarter earnings report, which just completely reset the narrative for this company. Most investors have been watching BigBear.ai with a healthy dose of skepticism. The expectation, the common belief, was that this was a small-cap, cash-burning AI company with a declining revenue problem, primarily tied to the unpredictable timing of government contracts. The stock has been a battleground, a favorite for both retail traders looking for a pop and for short sellers betting on its decline. The narrative was simple: good ideas, bad financials. But the reality, as revealed in the new earnings data and the accompanying strategic announcement, is something far more complex and has just thrown that entire bearish thesis into chaos. The company didn't just meet expectations, it delivered a report that fundamentally challenges the core reasons to be against the stock, and that is why we are seeing this explosive move. Here is what is happening. The company reported its third-quarter results, and while revenue did indeed come in at $33.1 million, a 20% decrease from the same time last year, that's not the part the market is looking at. The headline was the bottom line. The consensus analyst estimate was for a loss of 7 cents per share. BigBear.ai reported a loss of just 3 cents per share. This is a massive beat. In a market that is punishing cash burn, demonstrating that kind of operational control and a narrower-than-expected loss is a huge signal. It suggests that management is not just sitting idle while revenue streams fluctuate, they are managing the business. But even that is not the real story. The real story, the catalyst that is forcing a complete reevaluation of the company's future, was the announcement of a definitive agreement to acquire Ask Sage, a generative AI platform built specifically for the high-security worlds of defense and national security, for $250 million. This one move changes the entire conversation around BigBear.ai. The company is no longer just a data analytics provider for government agencies. It is now making an aggressive, large-scale pivot into the most in-demand sector of technology: secure, generative AI for mission-critical operations. Ask Sage is projected to bring in $25 million in annual recurring revenue in 2025, a figure that represents six-fold growth from its 2024 numbers. BigBear.ai just bought high-growth, secure sector AI. This isn't a small tuck-in acquisition, it's a statement. It's a bet the company moved to align itself directly with the future of defense spending. The market is now being forced to ask itself a new question. We are not asking if BigBear.ai can survive. We are asking what this company looks like when it combines its $376 million backlog with a high-growth generative AI engine. This is where the analysis gets extremely interesting, because this entire event is unfolding on one of the market's most crowded battlegrounds. This is a heavily shorted stock. As of the most recent data from mid-October, BigBear.ai has a short interest of approximately 18% of its float. That means for every 100 shares available to trade, 18 are held by investors betting the price will go down. This is an enormous number and places it among the most shorted names on the exchange. Naturally, when a stock with 18% short interest posts a massive bottom-line beat and announces a transformative acquisition, the first word that jumps to everyone's mind is short squeeze, and that is certainly a component of today's 16% spike. The 101 million shares in volume is not just new believers buying in. It is, without a doubt, a significant number of short sellers running for the exits, forced to buy back their shares at a loss to close their positions. But we must look deeper at the mechanics of this short trade. The common expectation is that a stock this heavily shorted must be incredibly expensive to borrow. When you short a stock, you must first borrow the shares from a broker, and if many people are trying to borrow the same limited supply of shares, the broker charges a high interest rate, known as the borrow fee. We've seen this rate spike to 50, 100, or even 200% for other popular retail-backed stocks. This is the reality check. The current borrow fee for BABI is, as of this morning, only 0.56%. This is not a typo. It is incredibly cheap to short this stock, and there are still an estimated 1.5 million shares available to borrow. What does this tell us? It tells us that what we are witnessing today is not a cost-to-borrow squeeze. Shorts are not being forced out because their borrowing fees are bankrupting them. They are being forced out because the fundamentals of their thesis just evaporated overnight. The bear case was built on declining revenue, a lack of a clear commercial path, and dwindling government contracts. Yesterday's report, with the Ask Sage acquisition, provides a direct counter-argument to all three of those points. This is a fundamental-based squeeze, which is far more powerful and sustainable than a purely technical one. The shorts are not in pain from fees, they are in pain from being wrong. This is a critical distinction for anyone currently holding or looking to trade the stock. For investors, it's essential to know how to track this information. You can find short interest data on platforms like Fintel or S3 Partners, which update this information twice a month. The borrow fee rates are more dynamic and can be seen on most active trading platforms like those from Interactive Brokers or on Fintel, which updates them frequently throughout the day. When you see a high short interest percentage, the very next thing you must check is the borrow fee. A high short interest with a low fee, like we see here, signals a bearish consensus, but not necessarily a crowded, desperate trade. A high short interest with a high fee signals a powder keg. Today, the fundamental news lit the match, not the fee structure. We must also be aware of other signals. In late September, BigBear.ai appeared on the Fails to Deliver or FTD list with significant volume. On one day, over 1.8 million shares failed to be delivered, and on another, over 500,000. FTDs can happen for administrative reasons, but a large, persistent spike in FTDs can sometimes imply shares are being shorted without being properly borrowed, a practice that is not legal. While the data is from September, it's part of the tapestry that has made this stock a focal point for retail investors on platforms like Reddit and X, who are constantly monitoring for signs of market manipulation. What's your take on the rising short interest over the past few months? Was it smart money spotting the revenue decline or a setup for a trap? Comment below. So, who is BigBear.ai? For those new to the story, the company operates in the world of artificial intelligence, but specifically what it calls decision intelligence. Its clients are or were primarily in the U.S. defense, intelligence, and national security sectors. Think of the Army, the Air Force, and intelligence agencies. BigBear.ai provides them with platforms that can take in massive, overwhelming streams of data from different sources, video feeds, sensor readings, logistics reports, and use AI to find the pattern, predict an outcome, and recommend a course of action. It's designed for mission-critical, high-stakes environments. The company's technology has been used for things like predictive logistics for the U.S. Army and through its past acquisition of Pangiam, facial recognition and biometric security for border control and airports. The problem has always been that these government contracts are lumpy. They are large, but they don't renew on a clean quarterly schedule, leading to the choppy revenue that has plagued the stock. The past performance has been a roller coaster, to say the least. The stock has a 52-week range of $1.65 to $10.36. It is a trader's dream and an investor's nightmare. It has been known for spectacular pumps on any AI-related news, often followed by a brutal dump as reality set in. This is what makes today's move so different. It is not reacting to a vague sector-wide tailwind, it is reacting to a specific company-altering set of facts. The acquisition of Ask Sage is a clear move to get off this roller coaster and build a more predictable, high-growth, subscription-based revenue stream. By buying $25 million in new annual recurring revenue, the company is diluting its reliance on those lumpy, project-based government contracts and building a base of steadier, more predictable income. This brings us to the future outlook. The bull case is now clearer than it has ever been. The company is sitting on a $376 million backlog. It has a fresh, high-growth generative AI platform in Ask Sage. It has a new CEO, Kevin McAleenan, who has deep connections within the government and defense sectors, and it is operating in an environment where defense spending is only set to increase, with proposals for a $1 trillion defense budget for fiscal year 2026. The bull thesis is that BigBear.ai has just positioned itself to be the go-to provider for secure AI in the defense world, a world that competitors like OpenAI or Google may be hesitant or slower to enter. The bear case, however, has not been entirely eliminated. It has simply shifted. The risk is no longer survival. The risk is execution. BigBear.ai just spent $250 million on this acquisition. It's paying a high multiple, roughly 10 times Ask Sage's 2025 revenue, which signals high confidence but also high risk.